The most frustrating thing about inflation is not that prices went up, it's that they don't have to come back down. Because when people hear that inflation is falling, or cooling, or improving, their brain expects something very simple: relief. Groceries should get cheaper, rent should calm down, mortgage payments should stop looking like a subscription to pain, and maybe, just maybe, buying eggs should stop feeling like you're negotiating with a luxury goods dealer. But that is not how inflation works. When inflation falls, prices are usually still rising. They're just rising more slowly, which is a little like being told, good news, your apartment is still flooding, but now the water is coming in at a more responsible pace. Technically, that's improvement. Emotionally, your socks are still wet, and this is why the economy can look better on paper, while regular people still feel like something is broken. Because the chart can say inflation is improving, the Federal Reserve can say progress is being made, economists can pull out graphs with the confidence of people who own standing desks. But then you go to the grocery store, and suddenly, the graph doesn't feel very comforting. So the real question is not, is inflation going down? The real question is, why does everything still feel expensive, even when inflation is supposedly getting better? And the answer starts with one of the most misunderstood ideas in economics: the difference between inflation and the price level. Because inflation is not the price. Inflation is the speed. Think of it like driving. If you are driving 100 miles per hour and then you slow down to 40, you are definitely moving slower. But you are still moving forward. You did not magically return to where you started. Prices work the same way. If prices jump by 20% and then inflation slows to 3%, that 20% does not disappear. It becomes the new starting point. The old price is gone. The new price becomes normal. And then prices continue rising from there, just more slowly. So that $4 item does not go back to $2.50. It becomes $4.12. Congratulations, inflation is down. Your wallet disagrees. And this is the first trap. Most people think falling inflation means falling prices. It doesn't. Falling inflation usually means slower price increases. That is a very different thing. And once you understand that difference, a lot of the economy starts to make more sense. In May 2026, consumer prices in the United States were still 4.2% higher than a year earlier. Core inflation, which removes food and energy, was 2.9%. Food was up 3.1%. Shelter was up 3.4%. And energy was up 23.5%. So yes, some parts of inflation may be improving compared to the worst moments, but the average household is not living inside a clean economic chart. It is living inside receipts, rent notices, insurance bills, grocery runs, car payments, and tiny moments where you look at the total and quietly wonder if the cashier accidentally scanned your soul. That is why the official story and the lived experience can feel completely different. The official story says inflation is getting better. The lived experience asks, better compared to what? Because if prices are still much higher than they used to be, then slower inflation does not feel like victory. It feels like the economy robbed your house, returned one spoon, and asked for a thank you note. But price levels are only the first part of the story. The second part is wages. Because in theory, higher prices are not always a disaster. If everything costs 20% more, but your income also rises 20%, your purchasing power survives. You are not richer, but you are not necessarily poorer either. The problem is, that is not how most people experience inflation. Prices move like they got the memo instantly. Wages move like the email went to spam. And even when wages do rise, they do not rise evenly. Some people get a raise, some switch jobs and earn more. Some fall behind. Some get a 3% raise and are told to be grateful, right after their rent performs an Olympic-level backflip. This is why wage statistics can look better than people feel. A paycheck can be bigger, and life can still feel tighter, because money is not about the number printed on the paycheck. Money is about what that number can buy. Pew Research looked at wages from the end of 1999 to the end of 2025. In nominal terms, median weekly wages more than doubled, from $482 to $1,040. That sounds huge. Until you adjust for inflation. After inflation, real buying power rose only about 11 to 22%, depending on which inflation measure you use. So the number got much bigger. But the life it could buy barely changed, and that is the part people feel, not the nominal paycheck, not the headline wage growth, the gap between what they earn and what life now requires. But there is another reason inflation feels so personal. Economists talk about inflation like it is one number, but nobody lives inside the economy. You live inside your own basket. If you rent, your inflation is different from someone who owns a home with an old low-rate mortgage. If you commute every day, gas prices matter more to you than to someone working from home. If you have kids, your grocery bill may have developed its own personality. And if you are trying to buy a house, your problem is not just inflation. It is home prices, mortgage rates, insurance, taxes, and the small emotional event that happens after opening Zillow. This is the problem with averages. The average can be true and still not describe your life. The Consumer Price Index is useful. It tracks a broad basket of goods and services. But your life is not a broad basket. Your life is rent, food, transportation, insurance, debt payments, utilities, and at least one subscription you forgot to cancel in 2021. Some expenses are flexible. You can delay buying a new phone. You can eat out less. You can pretend your old laptop has character. But you cannot simply stop needing housing, and housing is where the inflation story becomes much bigger than inflation. Because housing is not just another expense. Housing is the foundation of the household budget. If housing takes too much of your income, everything else becomes harder. Saving becomes harder. Investing becomes harder. Moving becomes harder. Starting a family becomes harder. Taking risks becomes harder. Even quitting a bad job becomes harder. Because when your fixed costs are high, your life gets less flexible. Harvard's Joint Center for Housing Studies reported that in 2024, 22.7 million renter households were cost-burdened. That means they spent more than 30% of their income on housing. That was 49% of renter households, nearly half. And 12.1 million renter households were severely burdened, spending more than half their income on housing. That is not just a housing problem. That is a life design problem, because when half your income goes to rent, the rest of your life has to squeeze into what remains. Food, transportation, insurance, debt, savings, emergencies, and maybe, if the economy is feeling generous, a slightly sad coffee. This is where people start to feel like they are falling behind, even when they are doing the right things. They work, they budget, they try to save, but the starting line keeps moving. And this is the part most inflation conversations miss. Inflation does not just raise prices, it changes the price of entry. The price to enter housing, the price to enter investing, the price to start a family, the price to build stability. Two people can make responsible decisions, live in the same country, earn similar incomes, and still end up in completely different financial worlds, because one entered the system before prices reset and the other entered after. One person bought a house when rates were low. The other started looking after prices and borrowing costs jumped. Same house, different economy. One person locked in a low mortgage. The other faces a monthly payment that looks like it was written by someone with a personal grudge. This is what inflation does at its most painful. It moves the starting line. And once the starting line moves, people who were almost ready suddenly feel years behind. But why don't prices simply go back down? If inflation hurts people, and if the cost shock is over, why doesn't the economy reset? This is where things get uncomfortable, because in many cases, the system is not trying to bring prices back down. It is trying to stop them from rising too quickly. That is a very different mission. The Federal Reserve's long-run target is not negative inflation. It is not, let's bring back 2019 grocery prices because everyone misses the old menu. The target is around 2% inflation over the longer run, which means, even in the successful version of the story, prices generally keep rising, just slowly enough that people can plan around it. And there's a reason central banks think this way. Deflation, falling prices across the whole economy, sounds nice if you are buying groceries, but across an entire economy, it can become dangerous. If people expect prices to fall, they may delay spending. If companies expect weaker demand, They may delay hiring. If wages start falling, debts become harder to repay, and suddenly the economy becomes a very depressing group project where everyone waits for someone else to do something first. So central banks usually do not want broad prices to fall. They want inflation to slow. They want stability. But stability does not mean the old world comes back. It means the new world stops moving as fast. That is why fighting inflation can feel like fixing the speedometer after the car has already driven to a much more expensive neighborhood. But even that is not the full story, because prices are not just mathematical, they are psychological. Once businesses, workers, landlords, consumers, and investors all start expecting higher prices, their behavior changes. Businesses raise prices because they expect costs to rise. Workers ask for higher wages because rent already did. Landlords raise rent because the market seems to accept it. Customers tolerate higher prices because, well, everything is higher now. And slowly, the new price level hardens, like wet cement. At first, it feels temporary. Then you look away and suddenly your $12 lunch is a permanent monument to bad timing. This is called expectations. And expectations matter because inflation is not just something that happens to people. It is also something people react to. And those reactions can help make it last. If enough people believe the floor is moving, everyone starts walking differently. And that changes the room. That is why inflation can feel like a rumor that became reality. A company raises prices because suppliers might charge more. Workers demand raises because bills already went up. Consumers accept higher prices because they have seen this movie before. And once everyone adapts, the temporary becomes normal. But there is another reason prices often resist falling. Companies do not love cutting prices unless they have to. I know, shocking. Some prices fall quickly. Gasoline can fall, airline tickets can fall, used cars can fall, certain goods can get cheaper. But many prices are sticky on the way down. There are reasons for that. Some costs stay higher. Wages, rent, insurance, financing, logistics. Some businesses use higher prices to rebuild margins. Some customers keep buying anyway. And if demand holds up, companies may not rush to give up the higher price. Because from a company's perspective, a price cut is not an act of kindness. It is a strategy. If they need to cut prices to keep customers, they might. If they don't, they probably won't. This is what creates a ratchet effect. A ratchet moves easily in one direction, but resists moving back. Prices can behave the same way. They jump quickly when costs surge. Then they come down slowly, partially, or not at all. And that is why the grocery bill can feel like it joined a gym and never stopped bulking. But the deeper story is not just that prices go up. The deeper story is that the entire economy resets around them. Employers adjust wages, landlords adjust rent, governments adjust budgets, consumers adjust expectations, investors adjust returns, businesses adjust margins, and after a while, yesterday's emergency price becomes today's normal price. This is why inflation is so emotionally powerful, because people do not compare today's grocery bill to last month's inflation report. They compare it to memory. They remember when rent was lower. They remember when a quick grocery run did not require a small strategic planning session. They remember when the same paycheck felt bigger. And that memory is not irrational. It is the human version of a price chart. It is how people measure whether life still feels possible. And this is where inflation becomes more than an economic issue. It becomes a wealth issue. Because inflation does not hit everyone the same way. If you own assets, inflation can be painful, but it may also push up the value of things you already own: real estate, stocks, businesses, land. If you have an old fixed-rate mortgage, inflation can even make that debt cheaper in real terms over time. Your payment stays the same, but the dollars used to pay it become less valuable. That can be uncomfortable to say out loud, but it is true. Inflation can hurt consumers while helping certain borrowers and asset owners. But if you rent, hold mostly cash, or spend most of your income on necessities, inflation feels very different. You do not get the asset inflation benefit. You just get the bill. That is why inflation can quietly widen the gap between people who own things and people who are still trying to get in. The person who bought a home before the price reset may feel squeezed, But the person trying to buy that same home today is playing a different game. Not because they are less responsible, not because they failed to hustle hard enough, not because they forgot to wake up at 5 a.m. and journal aggressively, but because the system changed the cost of entry. That is the hidden damage. Inflation does not just make life more expensive. It changes who gets to participate, who can buy a home, who can save, who can invest, who can take risks, who can wait, and who has to spend almost everything just to stay in place. This is why inflation is falling can be technically good news and emotionally useless news at the same time. Because the real question for most households is not, is inflation lower than last year? The real question is, can my income buy the life I expected? And for many people, that answer still feels uncomfortable. So when you hear that inflation is improving, understand what that actually means. It may mean the fire is smaller. It does not mean the furniture is unburned. It may mean the speed of price increases is slowing. It does not mean the old price level is coming back. It may mean the economy is stabilizing, but possibly at a level that still feels painful. And that is the hidden reason everything still feels expensive. Not because every statistic is fake, not because every economist is lying, not because the entire system is secretly controlled by one guy in a basement with a spreadsheet, although some days that would explain a lot. It feels expensive because inflation damage is cumulative. Prices rose, wages adjusted unevenly, housing became less affordable, expectations changed, businesses reset prices, and eventually the economy accepted a new baseline. The uncomfortable truth is this: inflation does not need to keep exploding to keep hurting. It only needs to stay above the life people built around, because once the price level moves up, life does not automatically move with it. Your bills adjust quickly, your salary negotiates, your savings absorb the difference, and your expectations quietly get rewritten. So the next time someone says inflation is falling, they may be right. But the better question is, falling from where? Because the economy can improve and still leave millions of people standing on a much more expensive staircase than the one they started on. That is the part most headlines miss. The real problem is not just inflation. It is what happens after prices reset. And the world asks you to rebuild your life around the new number. Got a topic you want me to break down next? Drop it in the comments. If you enjoyed this one, leave a like. And remember, question the headlines, understand the system. See you in the next one.